All right, onward. And I think onward, guys, is a term that almost everybody feels after a challenging year in both stocks and the bond market. Inflation and Federal Reserve, they're very much the focus last year in 2022, and that's going to continue to be an important focus for the year this year. But look for more of a focus on earnings and employment in 2023. Those were both areas of strength last year. That'll be a primary focus this year. And the question I think many people continue to have on their minds is the economy head for recession or soft landing? Well, we're going to look at clues today in the economic data. And I mentioned earnings. Well, what does it mean for stocks if we did see a cut in earnings? We'll have a brief review of 2022 and then onward. So Doug, how about a brief review of 2022?
Sure. So, we had Bruce Springsteen there at the end singing about the glory days. I don't know about you, but the last few days have kind of felt like the glory days of the market. Everything seems to be up, and hopefully we're putting 2022 in the rearview mirror. But what I wanted to do is take a few slides here to do a quick recap of what we saw in 2022, and more some of the nuanced points that people might have missed, but I think there were some really interesting things that happened last year. So just to start, we had inflation reaching an annual rate of 7%. And that was at the beginning of the year. And oh, by the way, the Fed funds rate was at 0. Okay. So now, that seems like so far away because, the Fed has come a long way trying to tackle inflation, trying to be tough on inflation. But we started the year with an inflation rate of 7% and a Fed funds rate of 0%. That to me is absolutely incredible. So what happened? Assets began to realize that the Fed is way behind the curve, and they, essentially begin to reprice based on higher rates. So we saw everything kind of going down in unison, but growth assets, or ones that are priced off of interest rates and have more sensitivity to those rates, were down much further than the normal market or things like value. So the Fed eventually becomes ultra aggressive in their quest to catch up with inflation. They raise rates 4% over a period of 10 months. And as I mentioned before, the sectors that benefited from years of low rates and high liquidity significantly underperformed. You had value and dividends as the best performers, and then you had bonds suffering their worst year since 1994. Speaking of the Fed, this I think falls under the camp of Fed credibility, Fed uncredibility, but this was actually said under these conditions. So on May 4th, 2022, with an annual CPI of 8.26% and the Fed funds rate at this point at 0.83%, Fed Jay Powell made this comment in a Fed meeting, and I quote, "A 75 basis point increase is not something that the committee is actively considering." What happened from that point? The Fed would go on to raise rates 75 basis points each at their next 4 meetings. So as we look back on 2022, and it's always easy to look in the rearview mirror and say, wow, I can't believe we missed this, or I can't believe we missed that. It was so obvious. Well, at the time you had the man who was charged with making the decision around the rate that is supposedly supposed to help control inflation, saying that they weren't considering being so aggressive, and then they turn around and do exactly the opposite. So, for most of 2022, it was a relearning process for a lot of people in terms of trying to gauge markets that had high inflation and rising rates. So, Dan, can you give us some context around some full year numbers, both in terms of what the equity market did and then what the bond market did?
Yeah, absolutely. So we're just going to do a quick little recap of 2022, what the best performers were, what the worst performers were on a relative basis. You see on this chart, we have the S&P 500, we have the Russell 1000 growth, we have the Russell 1000 value, which is more dividend focused. We have the SPDR MSCI ACWI, which is our international ETF, and then the iShares Russell 2000, which covers small caps. As you can see, that purple line, that's the S&P 500. So that's the main index that is tracked. It got down to as low as 24% at one point throughout the year, finished at about -18. But the main themes in 2022 were definitely focused on dividends and value being the outperformers. So that blue line there, that is value, the more dividend paying stocks, the quality stocks, that ended down 7.54%. Small cap stocks, which are pretty sensitive to, recessionary worries, down the 20.48%. And then you had the large growth stocks, which are the Teslas, the Apples, the Amazons, finishing down, what is that, 29% on the year. And then in green, if you notice there, that is our international index. So throughout most of the year, it tracked pretty well with the S&P 500, falling pretty much in lockstep with it. But then in Q4 of 2022, once the Fed was guiding towards slowing their rate hiking in the first half of 2023, international started picking up a little bit. So it rallied towards the end of the year, finishing down roughly 15%. So that's pretty much the equity picture for 2022.
So Dan, I don't mean to interrupt you, but
go ahead.
I want to clarify something. So what you're saying is international stocks outperformed U.S. stocks last
year? They did in 2022.
Unbelievable.
So that was the picture for the equity markets. Now we're going to take a look at the bond market. The bond market was very, very tough in 2022 in the face of the Fed raising interest rates at a pretty historic clip. On this chart, we have the iShares US Ag, which is pretty much an encapsulating index of the US bond market. We have the Schwab Value Advantage Money Market Fund. We have high yield, we have municipal bonds, and then we have investment grade corporates. So as you can see, it was a very tough year for bonds. The benchmark, essentially the aggregate bond, got to as low as 16%, 16.5% down in a year. And those are bonds. Corporate bonds, even worse, down close to 24%. So it was a very, very tough year for bonds. Munis fared a little bit better than the overall ag. And then you have the money market, which no one's really used for a very long time because it was yielding 0.01%, is started to look very, very good in 2022. The yields were rising as the Fed was raising rates, and right now it's paying over 4% risk-free, relatively risk-free compared to the other bond indexes. So it's a very good place to have your cash right now, and we're really enjoying collecting that 4% plus interest. So as we saw, equities and bonds were down in 2022, and we really just wanted to paint the picture of how rare this is. And I had to check this data because I was like, that can't be right, but it's only happened 3 times in the history, or since 1928. So 1931, you had the Great Depression. 1941, you had the start of World War II, and then 1969. And even with these numbers, Great Depression stocks were down 43%, which is really terrible. The bonds down 2.6%, 2% in 1941, 5% in 1969. I think we would have killed to be down 5% in 2022. So to have the S&P 500 be down and bonds down as much as they were, it was a very, very historical year.
Yeah, and I think this may be the only year that we've had since the 20s where you've had both of these returns in double-digit negative.
Double digits,
territory.
Yeah.
Yep. So yeah, definitely an outlier for sure.
Yeah. So looking at 2023 now,